in the UK we have a special kind of account called an ISA. But what is an ISA? ISA stands for Individual Savings Account. And although there are many types, they all have one thing in common, one important thing in common, and that's they're all tax advantaged accounts. Simply put, it's a tax wrapper. Think of it like strawberries. You plant seeds and hope they grow and that one day you can enjoy them when they're nice and ripe and juicy. The seeds represent your investments or the money you put away, hoping that it grows over time and you can use it later on for whatever you see fit. However, there's a problem. Strawberries are tasty and everybody wants a nibble. Next thing you know, you go to check your strawberries and there's little tiny bites out of them from all the birds and wildlife. These represent the tax man, who's always trying to have a little nibble on the fruits of your labour. So what do you do about it? Simple. You pick them up and put them in a greenhouse. Shut the door and now the birds and wildlife can't get to your stash. And the only person that gets to enjoy them is you. And in case you haven't guessed it, the greenhouse represents your tax wrapper, or your ISA. What this means in reality is, once you put money into an ISA, no matter how big it grows, the taxman can never tax it again while it's growing or when you take it out. Now this is the only account of this type in the UK. It's very similar to the IRA over in the US, but for once we've actually got it better than them. The amount they can put in is a lot lower than what we can, and also they can't touch it until they retire. So, a little win for us. Although there are many types of ISA, there are two main ones that people look at, and these are cash ISAs and investment ISAs, or stocks and shares ISAs. Cash ISAs are exactly what they say on the tin. They're a store of cash or money, and they have an interest rate tied to them. Now, like other accounts, this interest rate can increase if you lock up your money for longer, or if you say you're going to put in a certain amount each month, sometimes you'll get a better interest rate as well. Whereas if you went for something like an instant access cash ISA, that's somewhere you can take your money out whenever you want straight away, you're going to sacrifice a little bit of interest rate usually. This can change, but generally that's the rule of thumb. Now the minimum age to open one of these is 16 years old. So I qualify, just about. But the interest rates, as you well know, are absolutely rubbish. So for now, I've disregarded this, I've pushed it to the side, and if the interest rate increases, then I might think about opening one in the future. Next up is investment ISAs, or as some people like to call them, stocks and shares ISAs. Now these hold things like individual stocks, but also things like index funds, ETFs, trusts, and bonds. Now these are generally considered more high risk, and as a result, rather than being 16, you have to be 18 to open one of these accounts. Although historically, the S&P 500, which is just an index fund of the 500 biggest companies in the USA, has averaged 10% return since it started, there's no guarantee that the future will hold such returns, so you could lose money as well as gain money. This is why it's really important to only put money in the stock market if you're in it for the long term. If you're going to need the cash short term or in the near future, do not even bother looking at stocks and shares. You need time in the market to ride out the ups and downs that comes with the nature of the beast. Just to give you an example, my S&P 500 fund was up over 25% last year, and at one point this year it was down over 12% in a couple of months. The rule of thumb is only invest money you can afford to lose. Now there are other types of ISAs, like I said, and I'm just going to touch on these quickly. So we have the lifetime ISA, sometimes known as the LISA, and this comes in cash and investment forms, and it can be used to either save for retirement or to save for your first home. For this ISA, you have to be aged between 18 and 40, and you can only pay into it up to the age of 50. Now with a LISA account, you can only put in £4,000 per year, but the great thing is the government will actually top up 25%. So if you put in the max £4,000, they would put in £1,000 on top, giving you a total of £5,000 in your pot. That's great, but like I said, you can only use this to buy your first home if you're a first time buyer or for retirement, so you won't be able to touch it until you're 60. Of course, you can take your money out before you hit 60, but there are penalty charges involved, so you'll lose all of the government bonus plus a bit of your own money. So in this respect, it's a lot less flexible than a regular ISA. Next up, we have an innovative ISA, and this is basically a tax wrapper around money made from peer-to-peer lending. So peer-to-peer lending is a bit like you acting like a bank. You put money in and that money is lent out to either individuals or companies, and when they pay it back, you get an interest rate. The nature of this product means that your money is usually tied in for a loan period or a certain amount of time. Now this can be deemed as higher risk, and also it's a relatively new product on the market. It's something personally I don't do, but it is an option for you if you want to look into it. And just to throw one more at you, you can also open something called a junior ISA, and this is for if you have children or you have grandchildren under the age of 18, you can open up a cash or an investment ISA for them. But this comes with a stipulation that neither you nor them can get hold of the money until they're 18 years old, at which point they can either withdraw it or open a regular adult ISA. This all sounds great, right? No strings attached. Nope, sorry, there are rules, and they are as follows. Now this figure can change yearly, but you have a maximum amount you're allowed to pay in, and that's currently set to £20,000. And this is spread across all of your ISAs, so you can't go over that no matter how many ISAs you put money into. So if I wanted to split my allowance, I could put £10,000 into a cash ISA and £10,000 into a stocks and shares ISA. Now you can only open and pay into one of each types of the ISA per tax year. So for instance, I wanted to open 2 ISAs, I could open one cash ISA this year and pay into that, and one stocks and shares ISA this year and pay into that. Now there's nothing wrong with keeping hold of old ISAs. So say I had an ISA last year and the new financial tax year rolls round and there's a company offering a better rate than I was getting before, I could open and contribute to that new ISA and keep my old ISA open. It's also possible to transfer your old ISA into your new ISA. And to do this, do not withdraw cash from your old ISA and pay it into your new one, because you'll lose the tax advantages associated with that account. Instead, you have to go to your new provider and fill out a form called an ISA transfer request form. Now, if you did want to keep your old ISA as it was and it was an investment ISA, as long as you didn't pay into that ISA again once you'd started a new one, you're free to switch and change the investments within that ISA as much as you like. This is all great, but what taxes are there on savings? And do you even need an ISA? Well, I'm glad you asked. Now, if you earn interest on cash saved, you currently have an allowance which you're allowed to earn before you start paying tax on it. Now for this, it depends on your income tax rate. So if you're a basic rate taxpayer or a 20% taxpayer, you can earn up to £1,000 on interest before you pay any tax. If you're a higher rate taxpayer or 40% taxpayer, you can earn up to £500 in interest before you pay tax. And if you're an additional rate taxpayer, you can earn nothing before you pay tax. So you pay tax on the whole lot. After these amounts, it's treated as regular income. So again, it's in line with your income tax band. So if you're a 20% taxpayer, you would pay £20 for every £100 you earn in interest. If you're a 40% taxpayer, you would pay £40 for every £100 you earn in interest. And if you're an additional rate taxpayer, you would pay £45 for every £100 you earn in interest. I know, don't even get me started. You tax when you earn, you tax when you save, you tax when you spend, and you tax when you die. But what about investments? And this is where it gets a little bit more complicated, because there's actually 2 different types of taxes you have to pay depending on the investments you hold. The first one is called capital gains tax. Now you might have heard of this before, but basically this is a tax on the gain or the profit you make from holding certain types of assets. So this covers stocks and shares you might hold, but it also covers things like second properties or personal possessions like jewellery, gold, art, things like that. Now for capital gains tax or CGT in the UK, we also have an allowance of what we're allowed to earn up to a certain point before we start paying tax. Currently that's set to £12,300 per year. Anything above this, you'll pay a tax rate dependent on your income tax rate. So if you're a 20% taxpayer, you would pay 10% on anything above 12,300, and if you're a higher rate taxpayer, you will pay 20% on anything above 12,300. The second type of tax is dividend tax, and this is a tax on money you receive from holding certain types of stocks or dividend paying stocks, which is basically the company that you own the stock in giving you a little bit of their profit at the end of the year as a little thank you. Again, with this tax, we also have an allowance, and this is set at £2,000 for everybody. After this £2,000 allowance, there is tax to pay on anything above this. Now, the rates have just gone up, so if you're a 20% taxpayer, it's currently 8.75%. If you're a higher rate taxpayer, anything above 2,000 will be charged at 33.75%. And if you're an additional rate taxpayer, anything above £2,000 will be charged at 39.35%. Now I know you're hearing these figures and thinking, I'm never going to get there in a million years. There's no need to invest in an ISA. But hang on. The idea for me is to put money into an ISA I don't plan on touching until later on in life. And as a result, there's a high chance you could get to these limits. Now none of this is financial advice, and this is only my opinion, but if I could give my younger self one bit of advice, it would be to open an investment ISA much younger and just put a really small amount in on a regular basis, say £5 a week, which is pretty much just a coffee nowadays. And what I would do is invest in different type of index funds or ETFs, which are just groups of stocks and shares, and just have a play about with it, see how it works, get used to the concept and prove it to yourself over the long term. This would allow me to make mistakes when I only had a small amount of money in there. And once I got a system that worked and I'd found funds that I really liked and worked well, I would concentrate on upping the amount I was depositing into these accounts. I'd then implement a set it and forget it mentality. I would set up a direct debit on the day I got paid to go straight into my ISA. Let it work away in the background and crack on with my life. Hopefully you've got something out of this video. Thanks for watching.